America's economic relationship with China faces a dramatic shift as Donald Trump's re-election promises sweeping new tariffs on imports. At the forefront, a proposed 60% tariff on Chinese goods, plus an additional 10% across-the-board tariff on global imports. These policies aren't just numbers, they're reshaping global trade patterns and hitting key American industries harder than intended. China's strategic response has been calculated and comprehensive. Recent data reveals U.S. exports to China have plummeted to $47.81 billion in 2023, with preliminary 2024 figures showing accelerating declines across critical sectors. This isn't just a temporary dip, it's part of China's deliberate strategy to reduce dependence on American markets, while building stronger trade relationships with alternative partners. The impact on key American industries has been swift and severe. Let's examine the 4 sectors experiencing the most dramatic changes. Agricultural exports, once a cornerstone of U.S.-China trade, are witnessing unprecedented declines. Early 2024 data shows Chinese soybean imports from the U.S. dropped from 9.71 million tons to just 4.96 million tons, while Brazilian imports surged 21% to 6.96 million tons. This shift represents more than just changing market preferences, it's a strategic realignment of China's agricultural supply chain. American farmers, particularly in the Midwest, face shrinking market opportunities and falling commodity prices. The impact extends beyond just soybeans. Corn exports have similarly declined as Brazil emerges as China's preferred supplier. The technology sector tells an equally concerning story. Chinese semiconductor imports decreased 14.6% year-on-year in 2023's first 9 months, dropping from 46.7 billion to 35.9 billion units. This reduction reflects China's ambitious drive toward technological self-sufficiency. Chinese investments in domestic semiconductor production have accelerated, with new facilities being constructed at an unprecedented rate. For U.S. chip manufacturers, this means not only losing current market share, but potentially being locked out of the world's largest semiconductor market. The metals market disruption, particularly in scrap copper trade, highlights the immediate impact of trade tensions. China's halt of U.S. scrap copper imports has created a crisis in America's recycling industry. With China historically accounting for nearly 20% of the market, U.S. recycling firms face severe inventory buildups. Smaller operations, unable to find alternative buyers, risk closure. The ripple effects extend to employment. Communities where recycling operations are major employers face potential job losses and economic downturn. In the energy sector, while U.S. LNG exports to China increased 63% in early 2024, making America China's 5th largest LNG supplier, the longer-term outlook is concerning. China has strategically diversified its energy partnerships, signing long-term contracts with Australia, Qatar, and Russia. This diversification strategy reduces China's vulnerability to potential U.S. supply disruptions while creating new geopolitical alliances that could reshape global energy markets. The appointment of Scott Bessent as Treasury Secretary and Jamieson Greer as U.S. Trade Representative signals a potentially more aggressive trade stance. Market analysts predict these appointments could lead to expanded tariffs beyond the currently proposed levels. The impact on global markets has been immediate. Commodity prices show increased volatility, and supply chains are being restructured to avoid U.S.-China trade routes. For American manufacturers, the consequences are multi-layered. Higher tariffs on Chinese imports have increased production costs, while reduced Chinese demand limits export opportunities. Small and medium-sized enterprises, particularly those dependent on Chinese components or markets, face difficult choices between absorbing higher costs or passing them to consumers, potentially losing market share to international competitors. Looking ahead, several critical factors will shape this evolving trade landscape. The proposed 60% tariff could trigger additional retaliatory measures from China, potentially targeting strategic U.S. industries. American companies heavily invested in the Chinese market face difficult decisions about relocating production or finding alternative markets. Global market implications extend beyond direct U.S.-China trade. Countries like Vietnam, Mexico, and India are emerging as alternative manufacturing hubs. European nations find themselves balancing economic opportunities in China against pressure to align with U.S. trade policies. This realignment creates both winners and losers in the global economy. The metals market offers a revealing case study of these broader impacts. Beijing's decision to allow more recycled copper imports starting November 15 demonstrates China's adaptability. By modifying regulations and finding alternative suppliers, China maintains its industrial production while reducing U.S. market influence. This policy shift affects global copper prices and trading patterns, showing how bilateral tensions create multilateral market impacts. For businesses and investors, understanding these shifts is crucial for survival. The changes represent a fundamental realignment of global trade relationships, not temporary disruptions. Companies need comprehensive strategies addressing both immediate market impacts and long-term structural changes in international trade flows. Recent trends in specific sectors illustrate the broader economic implications. In agriculture, U.S. farm exports to China decreased 20% year-over-year, reaching $34.05 billion in 2023. The technology sector faces similar challenges, with Chinese firms accelerating domestic research and development while reducing dependence on U.S. technology. Energy trade patterns show increasing complexity. While overall volumes might rise temporarily, long-term contracts and investments suggest a strategic shift away from U.S. suppliers. The impact on U.S. jobs and communities cannot be overlooked. Regions dependent on agricultural exports, manufacturing, or recycling industries face particular challenges. The Department of Labor reports increased unemployment claims in sectors directly affected by reduced Chinese trade, while economic development agencies struggle to attract alternative investments to affected communities. Looking ahead, several scenarios could unfold. A best-case outlook sees negotiated compromises leading to stable, if reduced, trade flows. A more challenging scenario involves escalating tariffs and retaliatory measures, further disrupting global supply chains and economic growth. The most likely outcome lies somewhere between, a continued gradual decoupling of U.S.-China economic interests, with both nations seeking alternative partners while maintaining limited essential trade. For viewers interested in understanding these complex economic shifts, staying informed is crucial. These changes affect not just large corporations but small businesses, consumers, and local communities across America. Subscribe to our channel for ongoing analysis of these developing trade dynamics, and share your experiences in the comments below. Your insights help build a clearer picture of how these global changes impact real businesses and communities. Remember, while the current focus is on tariffs and trade statistics, the real story is about adaptation and resilience in a changing global economy. How businesses and policymakers respond to these challenges will shape economic opportunities for years to come. Thank you for tuning in. If you found this content insightful or inspiring, please show your support by liking this video and subscribing to stay updated with our latest releases. Your engagement means the world to us. And hey, why stop here? Check out another video from our channel, just a click away on your screen.